Thanks for joining me on the Profit Builder. In today's video, we're going to continue the series that we've been on, which is how do you plug the profit leaks in your contracting business? And in today's video, we're going to talk about reporting, and we're going to talk about how to use your financial reports as a powerful management tool and help you keep your finger on the pulse of what's working and what's not working in your contracting business. And in today's video, I'm actually going to share with you how to not just read and use your information, but I'm also going to give you some benchmarks for how to look at your financial reports, how to compare them to where you should be in terms of industry standards. And you'll get access to a free resource at the end. So make sure to download that and check it out and use it. All right, let's jump in. As a contractor, do you ever find that you don't want to really look at your financial statements, your profit and loss, your balance sheet, because you don't feel really comfortable necessarily looking at those numbers or know what to look for? Or maybe you just don't look at them because you know that the results aren't necessarily what you want to see. If you answered yes to either of those questions, you're not alone. I see this a lot of times with business owners where there's either a lack of comfort or confidence in how to use and look at those numbers, or you just don't really want to look at them because you know they're not going to show you what you would really like to see on your bottom line. One of the things I always say about numbers is that they tell a story. And when you can interpret and understand the story your numbers tell, it gives you so much more power to be able to influence the success in the trajectory that you're headed on in your business. And in today's video, we're going to talk about what are the key numbers that you want to pay attention to. And it's really maybe less than you think it is. And how do you use that information as a powerful management tool in building a more profitable and successful contracting business? Hi, I'm Vicki Suter with Suter Business Builders, and for over 30 years I've been helping contractors have a greater sense of clarity and confidence about how to run their contracting business so that they could take more powerful actions. And one of the places that I really teach people to embrace their feedback is by using their profit and loss statement and their balance sheet as a powerful management tool to help them have that greater sense of clarity and confidence. And so today what I'm going to walk you through are what are the key numbers that you want to pay attention to on those reports, and how do you look at them in terms of, how to really use it and how to have it be a great management tool for you. And one of the things that I always say is, well, there's two things. One is numbers always tell a story. And when you know how to interpret the story they tell, they become much more powerful and useful to you. And the second thing is that numbers in and by themselves don't mean anything. They only mean something in relationship to something else. So you probably have a sales goal for your business, and so having a sales goal or a revenue goal for your business, you probably look up and go, okay, how did I do compared to how I wanted to, right? That's one way of having a benchmark number for how you look at your financial data and look at it in comparison to what did I want to do. So let me just make a distinction between a profit and loss statement and a balance sheet. So your income statement or profit and loss statement is a reflection of the profitability of your operations for a period of time. That's usually anywhere between 1 month and 12 months, whatever your fiscal year is. And at the end of that period of time, it resets at zero and it starts over again. Your balance sheet is a reflection of your company's net worth or value from the time that you open the doors. And it says, how much have I accumulated as a value in my business? And we'll talk today about what are some of the key numbers that you pay attention to on that. And we'll also talk about some of the key numbers you pay attention to on your profit and loss statement. So you use them for different purposes, and we'll talk about which each of those are as well. So I'm going to talk today about your profit and loss statement and your balance sheet as it reflects to what are some benchmarks that you want to use compared to industry standards, compared to good business practices. But we're also going to talk about what are the key numbers that are really the drivers for the profitability of your business. So let's talk about profitability for a second. When you look at your operations of your business, there's only two ways to affect the bottom line. You have two options: increase revenue or decrease costs. Those are the only two things that you can affect the bottom line. And there's only two ways to do either of those things. The only two ways to increase revenue are to literally sell more, right? And you could sell more by selling more of what you already do, or you could add another line of service to what you do. Like I had a conversation the other day with a client who generally does remodel, reconstruction work. They're a subcontractor. They're thinking about adding a service division, right? So there's ways that you could either increase your existing services or add new services. Those are one of the ways to increase your revenue. The second way to increase your revenue is to increase your prices, to mark up more and charge more for what you already do. The two ways that you can decrease costs are literally spend less, right? You can spend less money on what it costs you to run your business, cut down on your overhead expenses, or you can increase the efficiency of your operations. In other words, you could create more efficiency in how you do work in the field on the production side of things, and thus increasing your gross profit or your net profit. Now, I will tell you that last one is by far the hardest of all four of them. But I like to make that distinction so that you understand, like sometimes it can kind of get a little overwhelming, right? You think, like there's just like so many elements, and I appreciate there's a lot of elements that drive your success as a contractor and as a business. And when you can understand what those key drivers are, sort of like from the 30,000-foot view and the most fundamental elements, it just helps us have a greater sense of clarity about, all right, where do I need to make an adjustment to impact my bottom line? So as we go through the profit and loss statement, I'll talk about that and some things that you can do and want to consider, that you could evaluate your own data and look at it and ask yourself the question, all right, if I'm looking to increase my profitability, what are the ways that I could do that? So I'm going to go ahead and share my screen, and here's what we're going to walk through today. We're going to walk through how to read and interpret the numbers on a profit and loss statement. We'll talk about some ways to be able to look at numbers comparatively. So I'll talk about benchmarks in comparing data against some industry standard numbers. We'll also talk about how to look at your own data internally and compare it from year to year and sort of interpret that story. And then we'll look at a balance sheet, and we'll talk about how to read a balance sheet, what are the different sections mean. We'll talk about some benchmarks there and some ratios that you want to start to evaluate and look at in your business that are a reflection of the financial health of your overall business. And then we'll talk about some standards around that. Okay, so I'm going to go ahead and share my screen. So this is a profit and loss statement for a general contractor, and this compares, it says 5 years data here, which I will show you in a second, but right now we're just going to look at this year compared to last year. So I'm looking at 2022 results compared to 2021, and then this column over here shows what the variance is, or the change from one year to the next. And we'll go through that in a second, but let's just talk about what are the different sections of a profit and loss statement. So there's income, right? That's kind of obvious. And then there is cost of goods sold. That's what did it cost me to generate that income. And then the next section down here is overhead expenses. What did it cost me to run my business? So overhead expenses are things like rent, utilities, telephone, insurance, overhead employees, your compensation may be part of it as the business owner, or maybe all of it. And then things like bonding fees, insurance, and so on, vehicle expenses. So then you've got total overhead expenses. And then the difference between revenue and cost of goods sold is gross profit. And I'm going to go back through these numbers in a second. We'll talk about how to evaluate that data. And then subtracting from that your overhead cost, you have your net profit for income from operations. And then there's usually other income and expenses on here and taxes. So on your very bottom line, net income before taxes, and then net income after taxes. Depending on the type of entity you are, your taxes are maybe paid through the corporation, maybe personal to you, but so that's going to vary. But the number we're really going to pay attention to is this number right here, net income from operations. That's where you have the most control over the profitability of your business. But before we get there, let's just scroll back to the top and let's talk about your income. So income tends to be a number where everybody has a goal, right? And so looking at your income number, remember I said there's only two ways to affect your bottom line: increase revenue or income, decrease expenses. So building your revenue number can be a way to increase your bottom line number. But we're going to talk about, for a general contractor, whether you're a general contractor or a subcontractor, when you're in the construction industry, you live and die by one particular number now down here, and that's gross profit margin. So what is gross profit margin? Gross profit margin is basically, let me make a distinction of terms first. Margin, just by definition, is a percentage. That's all it means. And it's basically your rate of return, right? Like, what's your rate of return on that revenue? And when I say that you live and die by it as a contractor, is that when you're evaluating your numbers on a percentage basis, it's what I call the great equalizer. So even if revenue goes up or revenue goes down, your gross profit margin or rate of return should stay consistent. Why is that? Well, your revenue goes up, your costs go up, right? The difference between what you get between those two numbers, that return that you get, should be consistent for your business and for your type of services that you provide. It's different for a general contractor than a subcontractor. It's going to be different for a contractor that does $3 million a year versus $30 million a year. It's going to be a little bit higher if you do $3 million a year versus $30 million a year. But your gross profit margin is a key way that you want to evaluate the results of your business. So revenue is one of the key numbers you're going to look at. And then gross profit margin is the second key number. And how that number is calculated, it simply takes gross profit dollars and it divides it, which is calculated by taking revenue minus cost of goods sold. And then your margin is calculated by taking those gross profit dollars and dividing it by income. Now, one of the interesting things about gross profit margin is that it doesn't matter where you are in the country, right? When you're looking at percentages, percentage rate of return is a great way to be able to evaluate how am I doing compared to industry standards. So it really doesn't, the dollars may change, and the dollars may change year over year in your business, but looking at what's my percentage rate of return is a key number to indicate the financial health of your business. Before we kind of talk about what are some key numbers, well, even let's just look at this. So if I look at this company, this is where, if I'm looking at just 1 year, it doesn't necessarily have so much meaning, but now I'm comparing this year to last year. So when I look at 2022, this company did $2.975 million in revenue. The year before did $3 million. So it's down $121,000. Gross profit margin wise, last year the company did 33.95 in gross profit margin. This year is 33.7. So not only is the company lower in income this year, also slightly lower in gross profit margin. So how do you know what a good gross profit margin is? Well, there's a couple of things. One is you would look at it year over year in your business and go, am I going up or am I going down, right? Is there a trend? Am I being consistent? There should be a consistency year over year. The second thing that when you look at gross profit margin, you could look at it compared to industry standards. So if you're a general contractor who does, I will say up to, depending, and this is going to vary depending on the size jobs you do. But let's say you do jobs between, up to $250,000, and your annual revenue is between $1 million and $8 million, then I'm going to say your gross profit margin should be somewhere between 32 and 35% gross profit margin. That's an industry standard. I didn't make up that number. I've worked with hundreds of contractors over these many years, and what I've seen is that financially healthy, strong general contractors run at about 32 to 35% gross profit margin with jobs about that size and with that volume of revenue. As your project size goes up, you're going to find that your gross profit margin tends to go down. And there's different ways to strategize about including in your bid costs for other overhead items that maybe when you're doing smaller jobs don't get included. Different topic, but just to kind of give you a benchmark for what you want to look at for that. By the way, there's a resource that I'm sharing with you in this post that includes a sheet that you can look at that will give you some benchmarks for your business. If you were a subcontractor is going to average somewhere between 40 and 45% gross profit margin because most of your cost is in labor, and labor always has a lot more risk associated with it and has a lot more markup associated with it. But also subcontractors have a higher overhead cost structure, just cost you more to run your business. So general contractors tend to have lower gross profit margins than subcontractors. So what you want to do is look at for your business, how am I doing over maybe several years? I highly recommend that you actually look at a 5-year period of time and look at how you're doing comparatively year over year. That will actually give you more information that can help you see, is there a consistency in how I'm producing jobs? One of the other important numbers to look at in here is what am I including in cost up here under cost of goods sold. So that's going to make all the difference in the world when you're evaluating your gross profit margin. And what goes into cost of goods sold is any costs related to producing that revenue. So that includes materials, field labor, including all of the field payroll taxes, benefits, workers' comp insurance. All of that is part of your cost of goods sold for anybody who works in the field. Included in that is obviously subcontractors and equipment. That's a cost of goods sold. And then also liability insurance. Your liability insurance cost is directly related to your revenue. That belongs in cost of goods sold. It also belongs in your bids. So making sure that you're including that as part of the cost when you're bidding work is really important. So when you're evaluating this data for your business, one of the things you want to make sure to look at is, are all the costs related to actually producing that work included in my cost of goods sold? That will really help you. So sometimes I notice when I do this that there's line items that are down under overhead costs, which we'll talk about in a second, are really belong up under cost of goods sold. So before I do this analysis and before you do this for your business, you may want to move some of those line items up. Okay, so when you're looking at revenue, looking at it comparatively this year versus last year, or even for a 5-year period of time, it is very helpful because remember what I said, numbers in and by themselves don't mean anything. They mean something in relationship to something else. And then evaluating and looking at your gross profit margin, right? So remember I said 2 ways to affect the bottom line: increase revenue, decrease costs. The only 2 ways to increase revenue are sell more or to increase your rates, to charge more for your services. And I'm going to talk in a second about how do you make sure that you're charging enough in your business to actually make sure that you're making a consistent profit on the bottom line. So when you look at gross profit margin, just evaluating that year over year, take a look and see, is there a consistency in that? First, make sure that all of your appropriate costs are in your cost of goods sold. So now let's take a look at overhead cost. So overhead cost, or what shows up as expenses, if you're using QuickBooks, it shows up as just as expenses. Those are, what does it cost me to run my business? And these costs tend to be more fixed in nature. Whereas the difference between cost of goods sold, if your revenue goes up, they go up. If your revenue goes down, your cost of goods sold goes down, right? There's a direct relationship between those two. But overhead costs are more fixed in nature in that it takes longer to reduce those costs when you're trying to spend less money. So as an example, rent, right? I mean, sometimes you can go negotiate to have lower rent, but rent expense tends to be more fixed in nature. So this is, what does it cost me to run my operations regardless of how much volume I have? Or I won't say regardless, because when your volume goes up a lot, your overhead expenses tend to go up. If your volume goes down, it's a little bit more difficult to get your expenses to go down. So these are rent, utilities, office supplies, cell phones, postage, janitorial, advertising, marketing costs, meals and entertainment. It also includes things like your overhead payroll, right? So it's got owner's salary, it's got overhead bonuses, administrative expenses, field downtime, right? When your field's not working on a job or they're on vacation, that cost is part of your overhead cost. That's part of the cost that when you're looking at bidding work, you want to make sure that you charge jobs enough and mark up your cost of actually producing work enough to cover your overhead costs. And so making sure that your overhead cost really represents, all right, what's all the stuff that it costs me to run my business that's not billable, right? I can't bill it to a job. I can't put it to a job because I don't make money on it, right? I can't bill for it. If I can't bill for it, it belongs in overhead, right? Liability insurance should be part of your contract and part of what you're charging to a job. Your entire cost for an employee, including all of those burden items, those are all chargeable to a job. Things like employee vacation and holidays, not so much, right? So you want to make sure that you have in your overhead a good idea of what is it really costing me to run my business. So when I look at this business has an overhead cost of 2021, $754,000, 2022, $709,000. So when I take your gross profit dollars and I subtract from that my overhead costs, I'm going to kind of collapse this a little bit so we can see the whole thing. Then I have net income from operations. So this is an important number to compare. So again, when I compare these numbers year over year, when I look at overhead costs, looks like I reduced my costs this year compared to last year by $45,000, and my net income is down by $22,000. The difference between my gross profit being down 67, overhead expenses down 45, that's 22,000. So when I look at these numbers, what does it mean? How do I know if those are good numbers? So let's talk about income from operations and what are some benchmarks that you want to look at. You ideally want to be between 8 and 10% is good in terms of net operating profit margin. Again, percentage, great equalizer. We want to look at it from a percentage point of view. So net operating profit of 8 to 10% is good, 10 to 12% is really ideal. That's for the construction industry. Again, if you're up to about $8-10 million, that's a good benchmark to have. When you start to get bigger than that and larger projects, you have bigger dollars, the percentage tends to go down, but not dramatically. Like if you're 2% on the bottom line, that is not a healthy net profit margin. But if you're at 6 or 7% and you're doing 15 million, that's probably fine. Again, I recommend that you download the resource I'm including in this and kind of evaluate your numbers and look at them. This company, the prior year did 9.58%. This year did 9.2%. So the percentage is not really very much different, just went down a little bit. And the company overall is still operating within that range of 8 to 10%. That's a good, healthy bottom line number. So why is it important to look at those things when I look at, a lot of times people tend to look at, I'm going to collapse this a little bit more. People tend to look at income and that they kind of stop there, right? But what I'm saying is the other key numbers you want to pay attention to. So you want to talk about income or revenue. You want to look at gross profit margin. And then you want to look at net income from operations. Those are three really key numbers that indicate the financial well-being of the operations of your business. And so you want to look at it comparatively, this year versus last year, or even better yet, look at it over a 5-year period of time. You can easily pull that data from QuickBooks and look at that data to see how are you doing year over year and compare it, right? So it makes it a really easy way to be able to say, hey, well, here's how we grew in terms of revenue year over year. And then when you look at gross profit margin, so I look at this and it was 29, 36, 33, 7, 33, 9. I can notice, oh, I was a little less consistent here, but I'm much more consistent here. And I look at overhead expenses, which I'm going to talk more about in a second, but you can see how the dollars were low, they went way high, came way down, went back up a bit, but proportionate to the revenue. And net operating margin really, and this is where dollars can change, but you're paying attention to the percentages, right? So when I look at this from a percentage point of view, 7.47, they didn't really make the mark in 2018, but 2019, even in 2020, even though revenue was down in those years, they stayed between 8 and 10% gross profit margin. Or net operating profit margin. That's great, right? So that's really a way, when you look at it from a percentage point of view, can be helpful. So I recommend, and I'm going to collapse this back down so that we're just looking at these 2 years, but I recommend looking at your data again. Look at it, you just pull a P&L up for 5 years and just look at it. Look at these numbers and just ask yourself the question, all right, what's impacting it, right? Are my cost of goods sold, do I have everything in there that should? And is my net operating profit margin 8 to 10% or 10 to 12%? And by the way, really important that if you're when you're evaluating this, make sure that your salary or your compensation is included in there. So if you're a sole proprietor and you don't take payroll, make sure to add that to your overhead dollars, right? That's important because 8 to 10% is after your compensation as a principal. Really important. And even if you take part salary and part draw, and that's like your total compensation is both of those, stick that draw number in there for the purpose of doing this analysis so that you can really look at, am I getting that kind of rate of return? Now, when I talk about getting that kind of rate of return, I just want to also suggest to you that this isn't just a number that I made up. This is really sort of an industry standard, and it's considered to be what's financially healthy. And I have worked with contractors all over the United States, and I have seen them consistently be able to produce that kind of a net operating profit margin. But how do they do that? I'm going to go back to what I have been saying a little bit ago, which is there's only 2 ways to affect the bottom line: increase revenue or decrease costs. One of the ways to increase revenue is to sell more. If you sell more and you don't increase your overhead, that's going to increase your net profit margin or operating margin. Increase your prices is the second way to increase revenue. That oftentimes is the key place where you as a contractor really want to consider, am I including all of the costs and carrying that through on my bids and making sure that I'm charging enough in my projects? And am I covering my overhead appropriately? Am I charging enough for what it really costs me to run my business? And I'm going to talk about that piece here in just a second. The 2 ways to affect the bottom line: increase revenue, decrease cost. 2 ways to increase revenue: sell more, charge more. 2 ways to decrease cost are literally spend less dollars in overhead expenses, or to increase the efficiency in production, which would increase your gross profit margin. And when gross profit margin goes up, those dollars going up goes directly to your bottom line. So increasing gross profit margin, one of the key ways to do that is make sure that you're charging enough to cover your overhead, and then making sure that all of your costs are included in that, so that you're not giving away some of your profits because you didn't include it in what it really cost you to do that work, whether that's burden for employees, liability insurance, workers' comp insurance. Make sure that all of that gets included in there. All right, let's talk about overhead for a second and your overhead break-even percentage. So your overhead break-even percentage is how much do I have to mark up my cost of goods sold just to make nothing on the bottom line. And oftentimes people get this number wrong. They look at the profit and loss, and you look at your total overhead expenses, and you look down here on the profit and loss that gets produced out of QuickBooks or wherever your accounting software is, and it says 24.37. This year it said 23.84, and people think that's how much they have to charge just to break even, or charge to mark up for overhead. But that number will actually bankrupt your business. That is not the correct number. And the way to actually calculate your correct overhead break-even number is by taking your overhead costs and dividing it by cost of goods sold. That's what this number is. So when I take your overhead cost, in this case $754,497 divided by 2,044,547, that is 36.9%. And this year it's 35.62. So if you're going to calculate this for your business, I recommend that you take a period of time of at least 6 months, ideally a year's period of time. Look at it and say, okay, what is that real cost for me? And calculate it. Now, let me just show you a little math of how having the incorrect number can actually dramatically impact your profitability. I'm going to hide a few lines here so that you can see this. Okay, so you see that it says overhead break-even percentage 36.9% and 35.62. But my profit and loss, if I ran a report, would show 24.37 or 23.84. So if I take 2022 data and I do a little bit of math down here and I go, okay, how much do I have to mark up to break even using the correct overhead break-even percentage? So if I took my cost of goods sold of $1,991,200, right, that's that number. That's my cost of goods sold for doing that work. And I mark it up by 35.62%. Remember, that's my number right here. So I mark it up by 35.62%. That gives me a contract price of $2,700,000. Less my cost of goods sold gives me gross profit of $709,000. My overhead costs are $709,000. So by marking up 35.62%, I just break even on the bottom line. Now imagine if you use the incorrect number. Same cost of goods sold, but instead I'm going to mark it up by this 23.84%. That gives me a contract price of $2,465,066. Difference between those two numbers, gross profit dollars, would be $474,000. My overhead $709,000. I just lost $234,000. So I realize that sometimes people look at their profit and loss and they think that's the number, or you just you mark up a whole bunch because you're like, I'm not making money, I'm marking up. But understanding this number and having that clarity to know what's my real overhead break-even number, and then how much do I actually have to mark up, gives you the ability to have more confidence in knowing how to price properly to be profitable. It lets you know when somebody says, well, can you do it for a little bit cheaper? Understand a little bit cheaper comes directly out of your bottom line. So it's a good idea to go do this calculation for yourself. Again, look at 5 years worth of data. right? Go look here, and you can see it varies year over year for this company. It's gone down the last couple of years from where it was here. But, you know, use your data, go look at it and evaluate it, analyze it. And I'm going to go back to what I said before. There's only two ways to affect the bottom line: increase revenue, decrease cost. If your overhead expense is too high, right? If you look at it, again, this is a general contractor who's doing about, you know, roughly $3 million a year in revenue, right, in volume and income, and who's doing about a 33%, 34% gross profit margin. That overhead expense is pretty consistent for them, right? So you might go, what's an appropriate overhead break-even percentage? It kind of depends on, are you a general, are you a sub, what's the volume you're doing, and so on and so forth. So that's why I say, look at your data, compare it, and see what it looks like for you so that you can determine, hey, is it, you know, is it going up or is it going down? And when I look at a profit and loss, I'm always asking the question, what are the ways that I can affect this bottom line, right? What are the ways that I can make a difference? Increase revenue, decrease cost. Does somebody have to sell more? Well, in this case, you know, I would say they're making their net profit margin of 8 to 10%. So that number is good. But if this number, you know, let's say this was $850,000, right? And I just plugged that number. Now I've got this big jump. I would say you have two options. You're going to have to either sell more because your margin is just fine, or you're going to have to reduce these overhead expenses. So, you know, you start to look at the numbers. I'm going to undo that. Look at your numbers, right? And just start to look at them and be curious, right? Look at the, you know, where is it line by line? You might look at your overhead costs and, you know, look at the line by line detail and go, where, you know, where's there a spike? Where's something gone way up? The more you can get confident, right, in knowing your numbers, right, the greater clarity you have in just looking at it. Don't be intimidated by it, right? Just sit down, look at it, analyze it, and be curious, like what's the story it tells. You don't have to try to figure it out all in one sitting, but just sit down with it and keep in mind, what are the key numbers, right? Revenue, income, gross profit margin, overhead break-even percentage, net operating margin, right? Margin, percentage, great equalizer. So it allows you that even though your dollars may change from year to year, looking at your numbers based on these percentages really helps to start to give you a better sense of how am I doing, even though the dollars are changing, and where do I have to influence my bottom line. Oftentimes, the place where I see people really need to adjust is how much they're charging for their services, that they're not charging enough to cover their overhead. Sometimes it's that you have to sell more, and then your choice is, I either have to reduce my expenses or I have to sell more. A lot of times, again, I notice that people, their overhead isn't necessarily that high. Sometimes it is if you've grown really rapidly and you've started throwing dollars at overhead and it's just really crazy high. But sometimes it's really you're not paying yourself enough money, you just need to sell more, right? The more confident that you are in your numbers, the more strength you're going to have when you're in those conversations of knowing when you can give and when you cannot give on a bid. Knowing how to bid properly so that you can charge the right prices so that you can make a decent profit. And the misnomer out there about it's what the market will bear. I will tell you that, you know, when people say 10 and 5 or, you know, 10 and 15 or whatever for markups for profit, or, you know, 15 and 10, what have you, those numbers, you know, again, I've done this for over 30 years, and oftentimes those numbers, unless you're a really large contractor, rarely ever look like 10 and 5 is going to give you a decent profit on the bottom line. So what it means is being super clear about what do I need to make sure is included in all my costs when I bid a project, and that includes marking up enough to cover your overhead. I will leave you just with this. My recommendation is that you take a look at your numbers, go pull up a profit and loss statement for 5 years, and just go look and see what are the numbers tell me. If you need to maybe adjust and move some of those overhead costs up to cost of goods sold or vice versa, if all of your payroll costs for overhead and field is all clumped together in one place, maybe start to separate it out, even if you have to use some estimates to do that, including the burden for it. And just start to evaluate it and look and say, all right, where do I need to adjust in order to be able to increase the profitability of my business? Remember, clarity gives you more confidence, lets you take more powerful actions. And the more you can have a relationship with your numbers, the more confidence you're going to have in being able to charge appropriately what you should in order to make a decent profit on the bottom line. All right, I hope this has been helpful to you, and I look forward to seeing you in the next video where we're going to talk about your balance sheet. Hello, and welcome back to this second part of this training video about how to use your financial reports as a powerful management tool and how to help you have a greater sense of clarity and confidence in using that data to help you build a more financially healthy and profitable contracting business. And in our last section, we talked about your profit and loss statement and how to use that and how to read it, interpret it, and how can you influence the numbers on your bottom line. And in this video, we're going to talk about how to use your balance sheet as a management tool for being able to have greater clarity and confidence to take more powerful actions about building a financially healthy and profitable contracting business. And in this video, we're going to talk about how do you read a balance sheet, what are the key numbers that you want to pay attention to, and how to set some goals for yourself about how to build a more financially healthy contracting business. So I'm going to go ahead and share my screen here in just a second. But before I do, I just want to remind you and talk again about the distinction between a profit and loss statement and a balance sheet. So your profit and loss statement is a reflection of the operations of your business for a period of time. Anywhere from 1 month to 12 months. At the end of 12 months, it starts again at 0 and you start all over again. And it tells you how effective have I been at generating a profit in my business for that period of time. And what we talked about in the last video is how do you look at that and compare it year over year, or another way to compare it is to industry standards, or even to compare that data to a budget, ideally, of what your goals are that you want to set for your business. Your balance sheet is a reflection of your company's value or net worth from the time that you open the doors. So what it tells you is, how have I done in terms of building a business that has financial value on the bottom line, a net equity number. We'll talk about that in just a second. And what does it tell me about the financial strength of my business in certain key areas? And so that's what we're going to talk about today. I'm going to walk you through the balance sheet and the different sections of it. I will explain to you how to read it and how to interpret it and how to use it as a tool for, as I say, building more financial health in your contracting business. So I'm going to go ahead and share my screen and we'll get started. So this is a balance sheet, and the balance sheet has 3 key sections. The first section is assets. The second section of your balance sheet is liabilities. And the third section is equity. So I'm going to go through each of those sections at a time. The current assets the asset section is broken out into current assets and long-term assets. Current assets, by definition, current simply means it's either in cash or convertible to cash within the next 12 months. And then long-term assets means they're things that have a value that isn't easily convertible to cash, but has a value to the business. In this case, it's fixed assets like trucks or tools or office equipment. And then those get depreciated, and then there's a net value of those assets on your books. And then the current liabilities is the next section, and similar to current assets, current liabilities represents
what's going to be owed in cash and come out of your cash in the next 12 months. So liabilities by definition is something that I owe, and what am I going to have to pay out in the next 12 months in terms of liabilities? What expenses do I have that I'm going to have to pay? That includes things like trade payables, payroll taxes, and so on. And then there's long-term liabilities, which is, it's a long-term note. In this case, there's a truck loan on here that has a longer term of payments that are due over an extended period of time. And then equity is the difference between those two. So equity is how much money did I put into the business when I opened it. It includes how much retained earnings you've had since the day that you opened your doors, how much have you taken in distributions, current year profits, and then the net equity of your business is this total equity number down here. And that number represents the net value of your business. So remember, I said your balance sheet is a reflection of your company's value or net worth since you open your doors. So retained earnings is how much have I made in profits year over year. And then when you look at current profit and loss, that is for the current year, how much have I made this year? That adds to your equity. So the equity for this business happens to be $471,250. This year, last year, it was slightly higher. The things that affect your equity are when you take distributions, your equity goes down. So what do you do with that information, right? Like how can that help you? Well, here's what's good to know. My experiences tells me that the clients that I've worked with for all of these years who look at and pay attention to and work at having a goal of at least 2 to 1 in terms of this current ratio tend to be people who struggle less from a cash flow perspective, who are able to withstand usually some downturn or unexpected event that happens in the economy, or some, a job that didn't turn out, or a project that got delayed, like that. Those unexpected events that can impact our cash flow, that companies that have and maintain at least a 2 to 1 ratio of current assets to current liabilities tend to be able to withstand those hits much more easily. And another reason that you want to have that as a ratio to pay attention to and look at as a goal for your business is that if you were going to go borrow to get a line of credit from a bank, this is a key number that they look at. And so you want to be mindful of that if you're going to go to a bank and ask for a line of credit. Not only do they look at your profitability, but this is one of the numbers that they look at on your balance sheet. They want to know that you have the capacity to actually pay that debt back. So that's one number that's really useful to pay attention to on your balance sheet. That's a reflection of your company's financial health. The other key number to pay attention to on your balance sheet is called your debt to equity ratio. And your debt to equity ratio, the formula is it takes total liabilities, which includes those current liabilities plus your long-term liabilities, and it divides it by your total equity. And the goal with this number is to have it be under a 2 to 1 ratio. So if I take 436,000 and I divide it by 471,000, it's a 0.91 to 1 ratio. That's well under a 2 to 1 ratio. Why is that important? What are you going to do with that information? Well, this is also a number that you're going to look at that tells you something about how leveraged you are. What does that mean? Well, if I have a lot of debt and I have to service that debt, I have to pay off that debt month in and month out, but it's long-term debt, right? And remember, long-term debt's not included in our current ratio, but if I have a lot of debt and I don't have a lot of net equity or value in my business, if my business slows down, there's an unexpected event, there's something that impacts my ability to produce and generate net profits, which converts to cash, then I'm going to have a hard time paying back that debt. It's a number just like current ratio that a bank's going to look at when they're looking at your ability to be able to pay back debt and service any debt that they're going to lend to you or extend to you. But also it's a number that when you're looking at projecting for profitability, you have to understand that out of your net profits for your business, you have to pay back that debt, which means if it's really high, you're really forced to have to produce a lot in terms of billings and net profits in order to pay that back. And I've seen it happen where sometimes somebody invests a lot in equipment and long-term liabilities and long-term commitments to loans on assets, that if those assets are not producing revenue, can really cause a problem in terms of cash flow and your ability to pay back that debt. So again, what are you going to do with this number? I recommend that you pay attention to this number and just calculate it for yourself. And what I've seen happen over time is that this is one of those numbers that just like your current ratio, that the more healthy this number is, keeping it under a 2-to-1 ratio, it tends to make it that your cash flow is a little bit easier. You're not struggling with cash flow, that it makes you so that if you do have to get a line of credit, you're going to be more credit worthy. But it also generally means that you have a business that's going to allow you to have cash that you can reinvest back into your business, that you can take as distributions, that it just builds a more financially healthy business. And if at some point you're wanting to sell your business or succeed it to the next generation, it's also one of those numbers that's going to impact your net equity and the value of your business. So those are a couple of numbers that I do this, I calculate this every month for clients, right? When we look at financial statements, I highly encourage you to start looking at that number. Those two numbers are good benchmarks. By the way, where did the 2-to-1 ratio over under come from? It's just a standard in business. I didn't come up with it. I learned it many years ago in a financial management class, and have had this conversation with many CPAs and banks over the years about, is that a good ratio? And those are generally good ratios to measure the financial health of your business against. So there's a couple other numbers that are useful for you to look at on your balance sheet. One of them is having a cash reserve goal. So another good standard in business is to have 3 to 6 months equal to your overhead in cash reserves. Why? Because when you have 3 to 6 months equal to overhead in cash reserves, it definitely tends to help this current ratio number. But also, similar to what I was talking about earlier, where there's an unexpected event, something that happens in the economy, a job goes away, a job has a large delay and it's a big part of your backlog, and you're now faced with, you can't just shut operations down, you have to keep your business going. Or you have an investment that you want to make, you want to grow your business. Having cash reserves equal to 3 months to 6 months is a really good practice in order to make sure that the cash is there when you need it. And when I say cash reserves, this is above and beyond the money that you have there to pay, taxes. This is above and beyond operating expenses to pay back any liabilities. This is like, I keep it in my business and I keep it in reserves. I will tell you that every client that I've ever worked with who has been really rigorous about this have found that their ability to withstand changes in the economy has really made a difference in their sustainability and their ability to be able to keep operations moving without a hiccup. So this business, you can see, does not have very much in cash reserves. They have a lot outstanding in accounts receivable. So in this particular case, if this was your business, one of the things I would look at is, okay, this company has a lot outstanding in receivables. What's causing that huge increase? And I happen to know the situation in this case happens to be a client who is not paid, who they have a long-term contract agreement with for them to pay over a longer period of time. That's caused that company to have to use their cash. It prompted a conversation with them where I said, hey, it might be good for you to take a look at that client relationship and let the client know, listen, I'm losing money on this money that we're floating for you. We need to charge you finance charges on it. And when they looked at the contract, their contract actually did have a clause in there for charging finance charges. And that's what they started to do, because when you're floating money for somebody else, it's costing you money, right? There's a lost opportunity cost in that. And there's also a higher risk in that. So if you have that clause in your contract, I highly recommend that you use it. And it's oftentimes a motivator to get people to pay their cash sooner. So the three numbers we've talked about so far on your balance sheet is your current ratio, liquidity ratio. You ideally want that at 2-to-1 or higher. That's a reflection of your company's liquidity and to be able to service your current debt and also have ideally build reserves. In this case, a lot of it's tied up in receivables. Current assets is anything that's convertible to cash in the next 12 months. Current liabilities, anything that's due in the next 12 months. And then we looked at debt to equity ratio, which is your how leveraged you are in debt. Your ideal goal is to have that be under a 2-to-1 ratio. And you want to make sure that you're not getting so leveraged with debt that it eats up all of your profitability, or sometimes I've even seen it where it eats up more than the profitability of a business. And then the third number that we talked about is having a cash reserve goal equal to 3 to 6 months of overhead. One of the other numbers that you want to look at when you look at your balance sheet is to consider how much do I have coming in receivables compared to payables. So even if for this company I looked at, there's receivables of $772,000 roughly, and there's payables, which includes all these liabilities, of a total of $418,000. So when I compare those two, I know that, oh, okay, there's going to be a net positive cash flow of $354,000. Well, that's good to know, right? I kind of want to know that because I want to know that cash flow wise, when I collect all those receivables, I pay all those payables, I'm still going to be ahead in terms of cash, and that's what's going to allow them to increase that bank savings number and build their cash reserves and possibly pay taxes and so on. So that's just a little bit about the balance sheet, some numbers that you might want to look at. You notice that I'm looking at this year compared to last year. I recommend that you look at that number, look at it comparatively. You may recall that I said numbers in and by themselves don't mean anything. They mean something in relationship to something else, right? So looking at this year compared to last year, looking at it compared to some standards of, current ratio equal to or over 2-to-1, debt to equity ratio equal to or under 2-to-1 ratio, cash reserve goals 3 to 6 months. What's the difference between my receivables, payables? Even if you just start to look at those numbers on a regular basis, it has you start to have a relationship with your numbers that will let you start to have a greater sense of clarity about where am I with my numbers, which gives you more confidence to be able to make better decisions, especially if you're about to make an asset purchase or invest money or pull money out of the bank account because it looks really good. Before you do that, go run these numbers, go take a look at it. It's a really good practice to be in to help you start to make better decisions about the profitability and the financial health of your business. I hope you found this information about how to read your profit and loss statement and your balance sheet to be helpful in helping you have a greater sense of clarity and confidence about how to use your financial information as a powerful management tool, and really how to start to look at that data in a way that lets you build a more profitable contracting business and financially healthy contracting business. I encourage you to go ahead and download the resource that I'm including here that is an explanation of much of what we've talked about in this video, and goes through and gives you some benchmarks that you can start to look at your data using that information so that you can start to assess your own financial information. As always, feel free to reach out to me if you have questions, and I look forward to seeing you next time on The Profit Builder. I hope you found today's video on financial management reporting and how to use your financial reports as a powerful management tool to be helpful. Make sure to go and check out the download that I provided that will help you be able to implement what it is that I shared with you today. Make sure to join me next week as we start to wrap up our final 2 videos in this series of
of how to plug the profit leaks in your contracting business. And in next week, we're going to be talking about project management and specifically about scheduling and how do you have an effective system for managing all the players involved on a project by having a good system for managing your schedule and how to do that effectively. And my guest, Robin, has been doing this for years and is very effective at it. And I'm excited to share that interview with you here. So make sure to keep your eye out for next week's video. Thank you again for joining me today, and we'll see you then.